If I told you that you could buy a 40-story skyscraper in the heart of a major American city, a building made of steel, glass, and concrete, a building that took 3 years and $500 million to construct for the price of a McChicken sandwich, you would call me a liar. You would say it's impossible. You would say the scrap metal alone, the copper wiring in the walls, the steel beams in the foundation, the glass panels on the facade is worth millions. And you would be right about the raw materials. But in 2026, the impossible has become the terrifying reality. The rules of value have inverted. We are witnessing sales that defy every principle of economics we were taught in school. A tower in St. Louis, once the jewel of the skyline, sold for $1. A massive office complex in downtown San Francisco, famously bought for hundreds of millions, sold for 10% of its 2019 value. A trophy property in Manhattan, an icon of American capitalism, handed back to the bank because the owner, one of the largest real estate firms on earth, couldn't even give it away to a competitor. This is the ghost tower crisis. And make no mistake, this is not just a real estate story. This is the single biggest threat to the global financial system right now. It is bigger than the debt ceiling debates. It is bigger than the annual deficit fights, because this crisis is hiding in plain sight, rotting on the balance sheets of the very banks where you keep your savings. It is a $3 trillion time bomb that has already stopped ticking and started exploding. The media tries to soften the blow. They use polite euphemisms. They call it a softening of the real estate market. They call it a structural adjustment. It is not a softening. It is a collapse. It is a slow motion implosion of an entire asset class. And the scariest part, the banks are lying to you about it. They are pretending that these buildings are still worth hundreds of millions of dollars. They are marking them on their books at fantasy prices. Because if they admitted the truth, if they marked these assets to their real market value of zero, the entire regional banking system of the United States would be insolvent by lunchtime. Today, we are going to walk through the wreckage. We are going to strip away the corporate speak and look at the raw, ugly math that killed the skyscraper. We are going to expose the extend and pretend scam that is keeping the zombie banks alive. We are going to talk about the urban doom loop that is turning our vibrant downtowns into hollow, crime-ridden shells. And we are going to answer the question, who pays when the city goes broke? Let's start with the basics. Real estate is not magic. It's not about location, location, location anymore. It is a bond wrapped in bricks. When an investor buys a skyscraper, they aren't buying the view. They are buying the income stream. They are buying the rent checks. For 50 years, the model was a money printer. Companies needed offices. It was non-negotiable. If you wanted to run a Fortune 500 company, you needed a tower. So they signed 10-year leases. They paid the rent every month, rain or shine. The building owner took that rent, paid the mortgage, paid the doorman, paid the taxes, and pocketed the difference. It was the safest bet in finance. But in 2020, the world broke. The pandemic happened. We all went home. We set up Zoom. We bought ring lights. And we realized something dangerous. We didn't need to go back. Remote work, work from home, didn't just change our commute. It destroyed the economic foundation of the skyscraper. It broke the monopoly that downtowns had on labor. Look at the vacancy rates. The official reports will tell you that vacancy in major cities is hitting 20 or 30%. That is catastrophic on its own. But the physical vacancy, the number of badge swipes happening at the turnstile, is even worse. Some of these buildings are 50% empty on a Tuesday. On a Friday, they are ghost towns. The lights are on, the AC is running, the security guard is sitting at the desk, but there is nobody there. Now, do the math. When a building is half empty, it doesn't just make less money, it loses money, it bleeds. You still have to heat the whole building. You can't just heat the 30th floor and let the 20th floor freeze. You still have to pay the property taxes, which are assessed based on the building size, not its occupancy. You still have to pay the insurance. Suddenly, your expenses are fixed, but your revenue has been cut in half. And then comes the interest rate shock. This is the nail in the coffin. Most commercial loans are not like your 30-year fixed home mortgage. You don't lock in a rate for 3 decades. Commercial loans are balloons. They typically last for 5 years. At the end of 5 years, you have to pay back the entire principal, or more likely, you have to refinance. You have to get a new loan to pay off the old one. Imagine you bought a building in 2021. Interest rates were near zero. You borrowed $200 million at 3% interest. Your annual interest payment was $6 million. The rent covered that easily. You were making a profit. Now in 2026, your loan is due. You go to the bank to refinance. The bank looks at the Fed funds rate. They look at the risk and they say, sure, we will lend to you, but the rate is now 7.5%. Do the math. Your interest payment just went from $6 million to $15 million a year. Your debt cost tripled. But wait, your rental income dropped because half your tenants left for remote work. So your expenses tripled and your income fell. The building is now cash flow negative. It is losing millions of dollars every single year. This destroys the value of the asset. In commercial real estate, value is determined by cap rate, capitalization rate. It's a measure of return. When rates go up, asset values go down. When a building goes cash flow negative, its value doesn't just drop 10% or 20%. It inverts. The building becomes a liability. If you own it, you are losing money. If you sell it, nobody wants to buy a money-losing machine. The only way to sell it is to essentially give it away. That is why it sells for $1. The buyer isn't paying $1 for the building. The buyer is saying, I will take this massive headache off your hands. I will assume the tax liabilities. I will pay the maintenance if you just give me the deed for free. The $1 price tag is an admission that the asset has become a burden. This brings us to the banks. And this is where the story shifts from sad real estate investor to national financial emergency. Who lent the money to build these towers? It wasn't JP Morgan or Bank of America. The too big to fail banks saw this coming years ago. They reduced their exposure. They got out of the office game. The lenders were the regional banks, the mid-sized banks, the banks with names you see on local street corners, the banks that lend to local businesses. These regional banks hold nearly 70% of all commercial real estate debt in America. They are sitting on hundreds of billions of dollars of loans backed by these ghost towers. Here is the nightmare scenario for a bank CEO. You lend $100 million to a developer to buy an office tower in Chicago. The developer calls you and says, I can't pay, the building is empty, the math doesn't work. Here are the keys. It's your building now. This is called a jingle mail situation, keys jingling in the envelope. Most of these loans are non-recourse. That means the bank can't go after the developer's personal assets. They can only take the building. So the bank takes the building. Now the bank owns a skyscraper. Banks are not property managers. They don't know how to lease office space. They don't want to fix elevators. But worse, regulations require the bank to mark the asset to market. They have to hire an appraiser to determine what the building is worth today. The appraiser looks at the market. They see the St. Louis tower selling for $1. They see the San Francisco fire sales, and they tell the bank, this $100 million asset is now worth $20 million. The bank has to write down an $80 million loss immediately. That loss comes directly out of the bank's Tier 1 capital, their emergency reserves. If a bank takes enough of these hits, their capital drops below the legal limit. The regulators, the FDIC, walk in on a Friday afternoon, shut the bank down, and seize it. The shareholders get wiped out to zero. The bank CEO knows this. He knows that if he forecloses, he dies. So he plays a game. It's called extend and pretend. When the borrower calls and says, I can't pay, the bank says, wait, don't default. Let's work something out. We will extend the loan for another year. We will lower the interest rate temporarily. You just pay us what you can. We will pretend the loan is still performing. We won't mark down the value. Why do they do this? Because it buys time. They are praying. They are praying that the Federal Reserve will cut interest rates back to zero. They are praying that a return to office mandate will force everyone back into cubicles. They are praying for a miracle. But here is the reality check. The miracle isn't coming. Interest rates might come down a little, but they aren't going back to zero. Inflation is too sticky, and workers aren't going back to the office 5 days a week. The culture has changed permanently, so the banks are extending loans into a black hole. They are capitalizing the interest, making the loan balance bigger while the building value gets smaller. Donald Trump, a man who built his entire career on debt and real estate, sees this clearly. He knows that extend and pretend has an expiration date. There is a wall of maturities coming in 2026 and 2027. Trillions of dollars of commercial loans are expiring. The banks can't hide it forever. Eventually, the cash runs out. Eventually, the regulators demand the truth. When that dam breaks, we aren't just looking at a recession. We are looking at a wave of bank failures that makes the 2008 crisis look like a warm-up. We are talking about hundreds of regional banks effectively being insolvent. The fallout isn't just financial numbers on a screen. It is physical. It is social. It is happening in your backyard. This is the urban doom loop. It is a spiral of destruction that destroys the very fabric of a city. Here is how it works. The office empties. The workers stop coming. The towers go dark. The support economy dies. The coffee shop downstairs that sold 500 lattes a morning, they now sell 50. They close. The dry cleaner, closed. The lunch spot, closed. The happy hour bar, closed. Thousands of service jobs evaporate because the office ecosystem is gone. The tax base collapses. This is the killer. Cities like New York, Chicago, and San Francisco rely heavily on property taxes from commercial buildings to fund their budgets. Commercial towers pay a huge chunk of the bills. When the building sells for $1, its tax assessment drops to near zero. Suddenly, the city government has a massive budget hole. Billions of dollars in revenue vanish overnight. The service is cut. The city can't print money like the federal government. They have to balance the budget. So what do? They cut services. They cut the police budget. Fewer cops on the beat. They cut the sanitation budget. Trash piles up on the streets. They cut the transit budget. Subways run slower and get dirtier. The flight. The residents look around. They see crime going up. They see trash on the sidewalks. They see the subway is unsafe. And the city, desperate for cash, tries to raise taxes on the residents to make up for the lost commercial revenue. The residents say, I'm out. They move to Florida. They move to Texas, they move to the suburbs, the population drops, the tax base shrinks even further, the cycle spins faster. This is the doom loop. Look at downtown St. Louis. Look at parts of San Francisco. You can walk down streets that used to be bustling canyons of commerce, and they are silent. Storefronts are boarded up. Homeless encampments have taken over the lobbies of abandoned buildings. It is a hollowed-out shell. The ghost towers are the tombstones of a bygone era. They are monuments to an economy that no longer exists. So what is the solution? How do we fix a trillion-dollar mistake? You will hear people say, convert them to apartments. We have a housing crisis, right? Just turn the offices into condos. It sounds like a perfect solution. It sounds logical. But have you ever looked at the floor plan of a modern office tower? They are huge, deep squares. The floor plates are massive. The plumbing and elevators are all in the center core. To make a legal apartment, every bedroom needs a window. You can't have a bedroom in the middle of a dark floor plate 50 feet from the nearest window. To convert an office tower, you essentially have to gut it down to the steel beams. You have to drill new plumbing through concrete slabs. You have to cut holes in the facade. It is incredibly expensive. In many cases, it costs almost as much as tearing the building down and building a new one from scratch. With interest rates this high and construction costs skyrocketing, the math just doesn't work. Developers aren't going to do it unless the government pays them to. This brings us to the political war that is coming. The mayors of these dying cities are going to go to Washington. They are going to go to the Trump administration and beg for a bailout. They are going to ask for billions of dollars in subsidies to convert these towers. They are going to ask for federal money to plug their budget holes. But is Donald Trump, a Republican president, going to spend federal tax dollars to bail out deep blue cities like Chicago and New York? It is highly unlikely. The Trump philosophy is likely to be, let it rot. Let the market clear. Let the prices hit zero. Let the banks fail if they made bad loans. He will argue that this is the free market at work. If the city mismanagement drove people away, the city should face the consequences. This means pain, massive pain. It means pension funds, your pension funds, that invested in real estate investment trusts, REITs, are going to take a massive haircut. It means your 401k, if it holds commercial real estate funds, is sitting on a ticking time bomb. Look at the stock charts of the major REITs. They are down 30%, 40%, 50%, but they haven't crashed to zero yet. They are still pricing in hope. when the $1 sales start hitting the headlines every week, not just once a month, that hope will vanish. And what about the buildings themselves? Eventually, they will be so cheap that they do make sense. Eventually, a visionary developer will buy that St. Louis tower for $1. Since the land cost is zero, they can afford to spend $50 million turning it into something completely new. Maybe a vertical farm growing food in the city center. Maybe a massive data center for AI servers, though cooling is an issue. Maybe a drone delivery port. Innovation comes from destruction. The forest fire burns down the old trees to make room for the new ones, but we are still in the fire. We haven't reached the regrowth phase yet. So what should you do? How do you protect yourself from the fallout of the ghost tower crisis? 1, audit your bank. Check where you keep your money. Is it a regional bank with heavy exposure to commercial real estate? Look at their balance sheet. If they have a high percentage of CRE loans relative to their capital, be careful. Move your cash to a too-big-to-fail bank, Chase, Buffet, or buy short-term treasuries. Don't be the victim of the next bank run. 2, check your 401k. Look at your holdings. Do you own REITs? If so, read the prospectus. Not all real estate is the same. Data centers, good. AI needs them. Warehouses, good. E-commerce needs them. Apartments, generally okay. People need to live somewhere. Office towers, toxic. Get out. If your fund is heavy on office, sell it. 3, the cash opportunity. If you are cash rich, this is the blood in the streets moment. Real estate is cyclical. It always comes back, eventually. But you don't buy on the way down. You wait for the capitulation. You wait for the moment when everyone says, real estate is dead forever. That moment is coming. When banks start dumping these properties for pennies on the dollar, there will be generational wealth made by the people who buy the wreckage. But don't catch a falling knife. Wait for it to hit the floor. The ghost tower isn't just a building. It is a symbol. It is a symbol of a changing world. The Industrial Revolution moved people from farms to factories. The Information Revolution moved people from factories to offices. The AI remote revolution is moving people from offices to everywhere. The office is no longer a place you go to. It is a server you log into. The skyscrapers are the cathedrals of a religion that no longer has any worshipers. Banks are trying to hide this reality because it terrifies them. They are trying to cover up the $1 sales. They are trying to pretend that 2019 is coming back, but you can't hide a 40-story concrete skeleton in the middle of Manhattan. The sale price is public record, $1. The collapse is here. The banks are next, and the skyline of the American city will never be the same. I will keep tracking the foreclosure auctions. I will keep tracking the bank balance sheets. I will tell you which bank is wobbling next. This is the slow-motion train wreck of the decade. Don't be standing on the tracks when the train derails. Subscribe to the channel. We see the ghosts before the banks admit they are dead. I'll see you in the next video.